So you're wondering, how can I buy my next house before I sell my current house? Well, in this video, I'm going to show you how. I'm going to take you through 3 different options to buy the next house, and if you stick around to the end, I'll share with you a bonus strategy that you definitely don't want to miss. And we're going to get after it right now. If this is your first time to this channel and you want to know everything about financing a home purchase, then subscribe below, tap the bell for notifications so you can be the first to know about updates to the mortgage financing world. My name is John Ritter with Ritter Mortgage Group, and we get calls and emails every day from people just like you looking for help on financing their upcoming move, and we absolutely love it. Whether you're moving in 9 days or 90 days, give us a call, shoot us a text, or send us an email. All of that information is in the description below so we can help you make a smooth move to your next home. So, I get asked by clients every week, how can I buy my next home before selling my current home? And there are generally 2 reasons why people ask this question. The first is convenience. In other words, it would be a whole lot easier to buy the next house, get it situated just the way you want it, with the painting, the flooring, whatever else you want to do to that property before you move in, and have all that going on while you're in the midst of unpacking and everything that goes along with that. You get all of that taken care of, and then you move in at your own pace over a few days or weeks, instead of trying to do it all in one day, like if you had a simultaneous closing where you sell your house in the morning, you buy your new house in the afternoon, you're loading everything up and unloading everything in the span of 24 hours. Now, this also allows you to go back and clean your home, do some touch-up, properly stage it so you can sell it for top dollar. It also helps tremendously if you're an animal lover and you have dogs. You don't have to worry about putting them away every time because there's a showing, because you've already got them over there in your new house. So it's a whole lot less stressful and it's convenient. The second reason why I get this question, and more so lately, is because in order to be competitive in a seller's market, clients want to know, how can they make an offer that's not contingent on the sale of their current home? Because in the eyes of a seller, a buyer that doesn't have to sell their home first is preferred over one that does. So how can you buy before you sell? Well, this really all comes down to 2 hurdles. What does your income allow you to do, and how much cash do you have? What does your income allow you to do? Meaning, can your income support 2 mortgage payments at the same time? Even though you intend to sell your house, the bank is still going to count your current mortgage payment, because they always look at things as the worst case scenario, which is you don't sell your house. So is your income enough to support the current mortgage payment and the new mortgage payment? If it is, then you've passed hurdle number 1. Hurdle number 2 is, do you have enough cash to make the purchase without the profit from the sale of your current home? To give you an idea, usually this is the step-up home. You're buying a bigger house, which typically also means it's more expensive. The minimum down payment is generally 5% on a conventional loan. So if you're buying a $500,000 house, the amount you need for your down payment is $25,000. But don't forget your closing costs. In our area, closing costs on a $500,000 home is around $15,000. So altogether, you're going to need about $40,000 of your own money to make this happen. Now, if you have that, then you've passed hurdle number 2, and that brings us to strategy number 1, a recast. You may be asking yourself, what is a recast? It might sound complex, but it's actually quite simple. A mortgage recast is where you make a large lump sum payment towards your principal balance, and then your lender recast or re-amortizes your loan. Think of it as a redo or a do-over. The lender will recalculate your monthly payment based on the new, lower loan balance. So after the recast, your payment goes down, but the remaining time on your loan remains the same. Now, this is different than a refinance because you're not replacing your mortgage with a new one. You're keeping the same mortgage, the same rate. You're just reducing your balance and dropping your payment. Now, as an aside, if current interest rates are better than your current mortgage rate, then a refinance may be in order. Now, why would you consider a recast? Maybe you received a large bonus or an inheritance, or you saved up a significant amount of money, or you purchased your new home before selling your old home And now the old home is sold and you have all this money from the profit of your sale that you want to be applied towards your mortgage balance so you can drop your monthly payment. Well, by recasting, you can reduce your mortgage payment monthly. And let me give you a quick example to illustrate. Let's say you purchased your new home and you took out a mortgage for $400,000. And now that you've sold your old home, you have $100,000 that you would like to apply to the new mortgage. Well, the new lender will re-amortize your new balance of $300,000 over the remaining time you have left, so your monthly payment will now be based on a $300,000 loan instead of a $400,000 loan. Now, a couple quick things to know about recasting. Most lenders offer recasting, but some do not, so you'll need to check with your mortgage company. Also, there may be fees associated with recasting, but they're typically very small, like $200, $250. So there you have it. Now you're a recast expert. If you're considering it, always consult with a financial advisor to see if it's the right move for you. This brings us to strategy number 2, a bridge loan. First off, what is a bridge loan? Think of it as a financial bridge. It's a short-term loan that bridges the gap between buying a new home and selling your current one. Another way to think of it is as an advance on your equity before you've sold your current home. It provides you the funds to purchase your dream home, and it allows you to make a non-contingent offer so you can compete and your offer can stand out. It can also help you appear to be financially stronger in the eyes of the seller. Let me give you an example. One time I had some clients who were looking to downsize and they wanted to be in a position where they can make a non-contingent offer, so we went the route of a bridge loan. The price range for the new home that they were looking for was around $500,000, and they were able to obtain a bridge loan of $250,000. So on paper, they were able to make an offer and state that they were putting down 50%, which looks huge in the eyes of the seller. Now, if they were competing against another couple who, let's say, were trying to use their own funds from their checkings or savings, whatever they could scrape to come up with for that minimum down payment and closing costs in order to make their non-contingent offer, they don't look as strong with 5% down as my clients did with 50% down. So by having more money to put down, this also allows you to deploy other strategies such as escalating the price, offering appraisal gap guarantees, or both. Now, there are some requirements with a traditional bridge loan. First, you must be able to qualify, meaning your income needs to be enough to support your current mortgage payment, the new mortgage payment, and the bridge loan payment. There are some new bridge loan options that may not count your current mortgage payment, or they may not count the bridge loan payment. But typically, you need to be able to support all three with your income, and that may or may not be realistic for you. Secondly, the bridge loan is not going to advance you all the equity in your home. Typically, they're going to go to about 80 or 85% of your home's value. This is because you don't know yet what your home may sell for. So we may need to make sure you have a buffer to make sure that you're given less than what your house sells for. The banks also want to make sure there's a buffer there to absorb your closing costs. You're going to have realtor commissions, transfer taxes, all those things associated with selling your house. So you need to have enough equity left over after the bridge loan is taken out to take care of those things. Thirdly, a bridge loan is a short-term loan. It usually ranges from 6 months to a year. The monthly payments are interest only, which means you're only paying the interest that accrued in the last billing cycle. There are no principal payments. As the banks know, the goal here is not to pay this loan off over time, and you're not going to make much headway in 6 months. So this does make it more manageable to afford the payment while you have your current mortgage payment and the new mortgage payment. But let me give you an example to show you how this works. Let's say your current home is worth $500,000 and you have a current mortgage on it for $300,000. The bank will give you up to 85% of what your home is worth, so 85% of $500,000 is $425,000. And let's say you already have a mortgage loan for $300,000, so we subtract that $300,000 from the $425,000, which leaves you $125,000 in equity to use as a bridge loan. So you buy your new house, you use the $125,000 as a down payment, you get settled in. Meanwhile, you sell your old house, the mortgage of $300,000 is paid off, the bridge loan of $125,000 will be paid off, and then whatever is left over from the sale goes to you. And you live happily ever after in your new home with your new mortgage without having to do anything else. Now, one quick note to add about bridge loans. There are some closing costs associated with a bridge loan, more than you would have with a recast, but the benefits may outweigh the cost for you to be able to make a non-contingent offer with a larger down payment, offer an appraisal gap guarantee, or be in a position to offer more than the list price. So you need to decide if it's right for you and your family and the housing market that you're in. And this brings us to strategy number 3, the old-fashioned way. Sell your house first and then buy the next house, but utilizing your timelines effectively. Now, this is not without risk, but I have seen numerous clients pull this off and not even need to recast or use a bridge loan. And here's what I mean. You can do this one of 2 different ways. First, you could sell your house and then ask the buyer for what we call a rent back. And that's exactly what it sounds like. You are renting your house back from the person you sold your house to. Now, the limitation with this approach is typically the buyer's financing is going to require them to occupy the property in 60 days. So that only gives you 60 days to find and close on your next house. So realistically, that means you have 30 days to find your house, and then you have 30 days to go through your inspections, your appraisal, your financing, all of that stuff. So it might be a bit ambitious, but it can be done. Now, it would be very important to have a backup plan on where you're going to live if you can't get it done in 60 days. If you have family you can stay with temporarily, then this may be an easy solution for you, but you may have to move twice, and that's the risk you run. The other approach is when you make your offer to purchase the next house, one of the items you will negotiate is the closing date. You can negotiate to close in 45 days or 60 days to give you as much time as possible to sell your house. So you turn around, you sell your house before you need to close on your next home. This works really well if your house is already staged, it's ready to go, and all you have to do is just put it on the market. Now, the limitation with this approach is that you have contractually obligated yourself to purchase this next home non-contingent. So if you haven't sold your house by the time closing rolls around, you need to be able to complete closing, and you can't back out with the excuse, oh, my home hasn't sold yet. You need to have a plan B in case your house doesn't sell. Maybe that plan B is the bridge loan or a recast. So if you can't qualify for more than one mortgage at a time, I would strongly advise you do not do this approach. So we've talked about the recast, the bridge loan, the old-fashioned way with manipulating the timelines. Now for the bonus strategy I promised for sticking with me through the end here. More and more we're seeing what some lenders are promoting as a modern bridge solution. It operates very similar to the traditional bridge loan, but what they add to it is a price guarantee. So in other words, they will evaluate your home and they will guarantee that they will buy it for a certain dollar amount if you're unable to sell it. Now, they're not hoping that you take them up on that offer, but that is a safety net in case you can't sell your home quickly. Now, what they're going to do is they're going to give you the money to use towards the next house, and what's nice is they're not going to require a monthly payment, so this helps those of you who do not have enough income to support the current mortgage payment, the bridge loan payment, and the new mortgage payment. You only have to qualify on the new mortgage payment. So when you sell your house, the bridge loan is paid off and you live happily ever after. Now you might be asking, what's the catch? The catch is when you sell your house, they're going to charge you a 2.4% transaction fee off of the sales price of your old home. Now it's not as bad as it sounds, because remember, they're not collecting any interest on the bridge loan, so you don't have a bridge loan payment while that's outstanding, so keep that in mind. All right, we've covered a lot of ground today in discussing the different ways you can buy your next home before selling your current one. If you have questions about which option is right for you, it is essential to consult with a mortgage professional like myself to understand all of the implications. I'm licensed in a dozen different states, and I have a referral network of like-minded mortgage professionals for those states that I'm not licensed in. If you found this video helpful, please give it a thumbs up, share it with your friends and your family. Don't forget to subscribe and for more mortgage insights. And until next time, happy house hunting.